Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by Benzinga Pro. I'm your co-host, Joel Elconin, along with Spencer Israel, and we have Mike Bailey on the line. He's Director of Research at FBB Capital Partners. Mike, how you doing on this Triple Widge Expiration Friday?
I'm doing just great. Thanks a lot for having me, Joel and Spencer.
Thanks for coming on the show. Tell us a little bit about FBB Capital Partners.
Sure. We are a registered investment advisor in the D.C. area. We're managing upwards of $900 million, and mostly for sort of a wealth management approach for families and that type of thing. So fairly traditional, I suppose, in terms of our approach, mostly fixed income and equities. We don't dabble a whole lot into some of the exotic things out there, but certainly plenty of volatility in plain vanilla securities such as stocks and bonds.
You have a tough job there, being a chair of the firm's investment committee. Tell us, what your responsibilities are under that role.
Sure. So yeah, we're a fairly flat organization, I suppose, which I guess another way of saying it. Folks wear a lot of different hats. So yeah, like you mentioned, the title is Director of Research, but I think we try to be flexible. So I think in general, I tend to generate a lot of the individual security ideas, but we do have an investment committee, so we've got some of our other portfolio managers. So we work together and hash out ideas, good, bad, and indifferent. I think we have a healthy debate as to what we currently own, things we want to be adding to, things we want to take away, and other directions we want to get into. So it's a collaborative approach, and I think it works pretty well.
Tell us a little bit about, your background, before taking on your current role.
Sure. So previously, I was an analyst for about 15 years and spent most of that time following healthcare. Did that a little bit on the sell side way back when, a couple firms, Raymond James and Bear Stearns, pre the events there. And then I was on the buy side for several years at Legg Mason in Baltimore, and most basically for that entire time was focusing on healthcare. Whether it's across the board, pharmaceuticals, devices, biotech, services, the works. So certainly got to see some interesting ups and downs, especially with the ACA and Obamacare and such, sort of experiencing that whole transition, and additionally some of the ripple effects we're still feeling today.
And also, you're responsible for analyzing the macro and microeconomic data. Boy, oh boy, we sure had some interesting macro changes today. Give us your evaluation of the Fed rate hike. Is this a one-off? Our last guest says he sees 3 to 4 hikes in 2016. What's your take on the latest move by the Fed?
Sure. Great question. Yeah, I mean, I think that as the previous guest said, I think most investors did expect the rate hikes. I think no major surprises there, and I think we're moving on to sort of what's next. And as you said, I think folks are really focusing on how many hikes in 2016. It seems like there's a debate starting to form. Is it on the low end? Is it 2 hikes? Is it 4 on the high end? I say, why not split the middle? And assuming there's no other major sort of unexpected plus or minuses in terms of other events out there, I would think 3 seems like a reasonable number. And we're still at fairly low rates now, and I think we need to start easing up towards something above 1% fairly soon. So I think 3 rates hikes probably gets you there.
And the from what you're seeing in the overall economy, I mean, there's enough strength in the economy to withstand these rate hikes.
Yeah, I get a feeling of that. I mean, I think if you kind of exclude energy, which I don't know if that's fair or not, but I think that's certainly the one area that's getting a lot of pressure. I would expect in 2016 you're probably not going to see the same pressure on energy companies that you saw in 2015. So you can kind of separate that. But if you look across the board, certainly some groups are doing a little better, some are doing a little worse. But we're not seeing anything that suggests sort of a secular downturn or getting extremely close to a recession. We can go sector by sector if you like, but I think certainly housing is doing pretty nicely. Industrials are a bit mixed. Some better, some worse. Healthcare is still doing pretty well. Some of the materials companies had some challenges. They're starting to come back. And consumer, certainly a little bit of a mixed signal there. But, again, winners and losers there. Some retailers are struggling and others are doing quite nicely. So you sort of net all that out. You can look at just sort of go up to the GDP numbers, and I think you expect kind of low single-digit GDP growth. corporate profits growing a bit faster than that. And I think that kind of roll all that together, and that gets you to probably something like historical equity market performance. Mid to high single digit is what we'd expect at this point.
S&P futures have caught a bid here. We are now trading up 4 points here. We just went up and kissed the high at 29.75. 4 o'clock yesterday, we were trading 32.50 and had a 20-point drop, and now we're getting it all back. So a lot of volatility in today's market. Mike, you also look at microeconomic data. Tell us what kind of microeconomic data you look at, and what are you seeing?
Sure. So, I think from the micro perspective, it's basically just, company by company and doing due diligence and trying to just really turn over stones and see what companies are doing out there. So, we just look at different companies and sort of try to get as much intelligence as we can, customers, competitors, suppliers, that type of thing, meeting with companies and just getting a feel for what they're seeing and what they think their competitors are doing. So, no major surprises there, but I think it is important to just really meet with folks face to face, and if a company is going to be managing the assets where you're investing in that company, I think you do want to know who's running the show and that type of thing. So really we look at that, and ideally, since we've got a fairly small team of folks looking at micro and macro, we try to put the two together. So for example, if you were to look at Lowe's, let's say in the consumer space, company's doing pretty well. Obviously, that's a play on housing. So if you were going to own Lowe's, which that's like one of our larger holdings, you want to be comfortable with the macros in housing. So we're certainly looking at those two. And obviously, if you think housing's going to do well, you probably want to look at the economy overall. And like I said, we think that we're going to expect sort of low single-digit growth in general, and housing sort of fits into that nicely, sort of still bouncing back from the Great Recession. So try to put all the pieces together. Never as simple as I think we'd like it to be, but that's certainly our approach.
So you just mentioned a couple of secular industry trends here, and we're looking at the end of the year, little end of the year window dressing, tax loss selling. What are going to be some of the you mentioned a few, but what other industries you think are going to be leading the way here in 2016?
Yeah, I think just to touch on a couple, I think one that's interesting, I mentioned Lowe's. So consumer is certainly an area where I mentioned earlier we've seen some winners and losers. One of the things we're looking at in the consumer space is basically try to figure out who's not going to get Amazoned. Basically that's just that company is really
nice phrase. Who's going to get Amazoned? I like that. Can I use that, or do I have to give you credit?
Sure.
Okay.
Go for it.
All right, go ahead.
So basically, if we kind of step back and look at what's going on in the consumer space, it seems like you've got folks on one end really demanding sort of high-end experiences, and on the other hand, they're also looking for extreme value and kind of getting that very quickly. So Amazon, I think, takes that low end. If they've got the value and they've got the fulfillment that's almost immediate. The flip side is companies who can deliver some type of experience. And we're basically looking to avoid companies stuck in the middle. So if you're selling some type of commoditized product, or you're selling something at a B or C grade mall, something like that, that doesn't really provide much of an experience, and also the asset that the consumer takes away is maybe not that exciting. So you mentioned Lowe's. Lowe's is just certainly a home improvement company. It's really tough to, if you're renovating your house, hard to buy everything you need on Amazon. And also I think they've got the experts at a home improvement store like that. So that's something we think is pretty defensible here, obviously with the housing market doing pretty well. A little bit of a kicker on Lowe's is that their profit margins are below Home Depot. So if you like that group and you believe in the law of small numbers, I think Lowe, that's an area where we've got greater confidence that they can generate faster earnings growth than their number one competitor. Just a couple of others in consumer. So I mentioned, companies that can, sort of provide value, but also at a decent experience or at a sort of a better location. TJX is certainly one that has done nicely, and basically they're winning while some of these other mall-based retailers are losing. So I think a lot of consumers see pretty good value there, and they want to get in and get out, get their products and move on. Interestingly, with TJX, I think the company's doing about $30 billion a year in sales. You can almost draw a straight line looking historically and looking ahead. They're talking about $40 billion in sales in a few years. that's 30% upside. You look at some margin expansion on that, maybe some a better tax rate, some debt pay down, and some share buybacks. You're looking at 40-50% upside in a few years. So companies like that, I think, are pretty impressive, and also, again, they can avoid sort of the trap of Amazon. And maybe just one last one, if we have another second, in consumer, if it makes sense. So, yeah, I mentioned a couple of retailers. Another way to look at consumer space without looking at a retail company is Nike. So, you could argue that, maybe Nike at some point gets there's a risk there of something like an Amazon, just digging into it and taking share from that space. But it seems like consumers are looking for experiences, and they view Nike as a premium brand. They really don't see a whole lot of competition there, and so that's something where Nike's doing well. They're going after the women and female athlete market, also going internationally, and they've got the Olympics coming up next year. So companies like that, I think, are pretty impressive. They're growing nicely, and I think they're going to avoid, I mentioned, the trap of selling sort of B-grade products in a B-grade mall.
I think we have a question from one of our analysts. Nick Donato has a question for you if you want to hop on, Nick. Hey, Mike, how's it going, man?
I'm good. How's it going, Nick?
Good, good. So, one of the things I kind of wanted to ask, yesterday was kind of a little bit crazy with Martin Shkreli getting arrested. We got K-Bio that's halted, and some of us on the desk think it might be halted forever. And then we have Valiant, we have a couple other. It just seems like there's a ton of regulatory pressure hitting the biotech sector right now. I mean, do we see this continuing into next year? Are we going to see, pressure on some of these big biotech names? Just kind of seeing what you think on the regulatory part of the industry.
Sure. So, I think I would try to separate, regulatory from media and hype and kind of politics, and sometimes those circles overlap, sometimes they don't. On the regulatory piece, I think that the biggest concern is something with pricing. It seems that's really what's been in the news. Again, as a recovering healthcare analyst, my sense is it's pretty difficult to see. For example, the FDA is never going to regulate pricing. That's just not what they do. Could you see other parts, Congress or other areas, try to regulate drug pricing? Certainly possible, but again, my years of experience following that space is it's going to be very, very difficult. In fact, I think there's some laws in place basically saying that the government can't control drug pricing. I think there's just some rules within Medicare Part D, which is a prescription drug benefit. So I would, especially just looking at drug pricing, I think we're unlikely to see a lot of new rules coming out. If you were to speculate on other things, I think, again, it's pretty difficult. The FDA moves at a glacial pace, and interestingly, they've actually been, I think, more favorable towards the biotech industry over the last few years. They came out in, I think, sort of the 2012-13 time frame and essentially lowered the bar for biotech approvals. It basically said if there's a rare disease out there and you've got a drug, and historically you'd have to run that drug on a ton of patients, but if it's a rare disease, you can run it on a smaller number of patients and get sort of a tentative approval. And I think that's one of the triggers that set off the biotech sort of bull market a few years ago. I don't see anything that would reverse that sort of number of regulations coming out of the FDA. I would see it as neutral or perhaps positive in terms of the biotech group.
Anything you're avoiding in 2016?
Yeah, great question. I think in general, we talked a little bit about commodities and the energy space. So we're underweight energy at this point. I think we're going to maintain that split stance. You could argue with oil at sort of the mid-30s. It seems like it's closer to a bottom than a top, and I would tend to agree with that. But I would have said the same thing at 40, 45, et cetera. So I think it's going to be a bit of a tough slog for energy, and perhaps it's something where later in 2016 the group has a better chance to perhaps outperform in 2017. But I think that's a group where it makes sense to have some exposure because a little bit of a call option in case the group does work out. But I think being underweight is probably a smarter move.
We've been on the line with Mike Bailey, Director of Research for FBB Capital Partners. Great information. Covered a lot of things there, Mike. We hope to have you on again soon.
Great. Thanks for having me.